In this video, we're going to talk about some investing fundamentals. This is to start introducing the basics of investing. There's a lot more to investing as you learn more about finance, but here are your first steps. And remember, it's always about planning. So first you need to establish your investment goals. You want to write them down or type them, however you want to do it. But the point is, you want to have it somewhere in write. They need to be specific and measurable. You can't just say, I want to be a millionaire. You could argue that that means $1 million, but it could mean a lot of different things. Let's say you want to say, I want to be a multimillionaire. Okay. How many millions? By when? How do you keep track that you are getting there in the timeline that you will like to? That's the measurable part. A lot more details go into that. To develop valid goals, ask yourself a few things. How much money do you need to satisfy your investment goals? Now, that is on both ends, going in and at the end of it. So let's talk about retirement, or maybe putting together a down payment, saving for the down payment of a home. The point is that you need to know how much money do I want in the future, whether it's for my retirement, for the down payment of the home, save up for whatever it is. So you want to start there. And then with the information available and the options you have to invest, then you have to decide, well, how much money do I need to put in now so I can have that amount that I want in the future? You will also then need to establish a timeline. Now, all those things may have to change depending on what the numbers come out, but those are your first steps. How much money do I need in the future? How far in the future do I need it or want it? And then how much do I need to have now to start investing? And periodically as you go. How long will it take to obtain the money? Now, on that sense, it's a time thing, but not necessarily the time that I was talking about a second ago. Let's say you need to put a large initial investment. Well, how much does it take you to accumulate that first large initial investment to then get started in investment? How much risk are you willing to assume in an investment program? In the long run, the average of an investment will play out, but it's not steady. If you have an investment that's going to average, let's say 12% a year, that's fine, but that doesn't mean you will see 12% every year. You can go a couple of years with negatives, and then the next couple of years after that, big jumps of 25 and 30%. This may happen. So you got to be willing to have that patience and not panic on those bad years. Because if you're not willing to take that risk, what happens to people that panic? They pull out when it's at a loss, and then you actually lost money. You never really made the money you were trying to make. What possible economic or personal conditions could alter your investment goals? In that sense, they're talking about two things. Economic conditions could be things that happen outside of your control. Interest rates, the market is down, pandemics, anything that might have a disruption. It could be in a good way or a bad way. Inflation, all those things that are in your control but may have an impact. Also, then your personal conditions. You may lose a job. You didn't get the pay raise you were counting on. There could be a pay cut. All of a sudden, there was some emergencies throughout time that you were not able to save money, had to spend on emergencies. A loss of a job. All kinds of things that can happen. All of a sudden, you get married or start having kids. All those things you may think you know in the near future what you want in life, but then a few years go by and now you want to start having kids, for example. It just happens. Are you willing to make the sacrifices necessary to reach your investment goals? At the end of the day, in order to put money in your investments, you can't spend it. So then less eating out, maybe a lower quality car. And by quality, I mean, I guess brand. It doesn't have to be a bad car. By quality, I just mean is that the $20,000 car can probably do you as just as much good as the $50,000 car. So are you willing to make those sacrifices? Less leisure. What will the consequences be if you don't reach your investment goal? So, for example, if it was the down payment for a home and you don't reach it, the consequences is that you have to rent for a little longer. You have to buy the house a little later. Same with retirement. If you don't reach the retirement goal, that means you have to work more years. You want to do a financial checkup, ethical concerns, paying your bills on time. To give a quick example, a few moments ago, we spoke about that you have to sacrifice dinners and leisure and vacation, maybe things that are not necessary, but bring you some kind of enjoyment. You have to sacrifice those things. Well, some people decide to not sacrifice those things, but what they do is they start skipping. They don't make their credit card payments or their electrical bill or their phone bill, whatever, pick one. And that's how they put money in investments that are paying the bills they're supposed to be paying. So that's not a good thing. Work to balance your budget. Do you regularly spend more than what you make? People do that all the time. That's how they end up with a lot of credit card debt. Manage your credit card debt. There you go. Start an emergency fund. The reason we say that you should do this first before getting into investments is because if an emergency happens at the time that your investments are in a downturn, and remember we spoke a moment ago, that's going to happen, and you just have to be able to wait out the downturns to then take advantage and enjoy the upswings. But if an emergency happens in a downturn, it forces you to sell some of your investments, to liquidate, in order to have access to that money. And all you did was take the loss, because you really don't take the loss until you sell it. The price of your investments or the value of investment is going to go up and down, but you didn't really lose until you sell it. So you want to have that emergency fund and then get into investments, because that way, when emergency happens, you don't have to take a hit unnecessarily on your investments. And since there are 3 to 6 months of living expenses, that's a rule of thumb. Every individual is different. A lot has to do with your job risk. Do you have a job where you may lose your job at any given time, or you have a job that if you do lose it, takes a long time to find the next available spot? So that one you have to assess your situation. On average, for most people, they can get another job within 3 to 6 months, or at least a suitable, because the income is not guaranteed either, that you can have the same income. Have access to other sources of cash for emergency needs. It is okay to have credit cards and lines of credit available to you. Just don't fall in the trap of using them unless you absolutely need them. Getting the money needed to start an investment program. Priority of investment goals. How badly do you want to achieve your investment goal? Well, and this one, behavioral finance comes in play. You may find a lot of people saying, like, I want to retire by this age with this much money. And they say, I want it really bad. And as soon then you tell them, well, you got to stop spending money on this. You have to sell some of these things. They have, let's say, multiple cars and a boat, and their investments are really low. So if you want this much money by that age, you have to give up some things. And then they decide not to. They don't want to. So then they don't want it that bad. They like it. They will like to get it, but they're not willing to do the sacrifices. So how badly? It's pretty much a way to say, well, how much sacrifice are you willing to make? Are you willing to sacrifice some purchases to provide financings for your investments, as we just spoke about? Take advantages. And this is their sacrifice purchases, sure, sacrifice future purchases. But as I mentioned in my example, sacrifice current things you have. I'm going to use the boat as an example. There's plenty of people that may have a small boat, doesn't matter. But the gasoline of a boat, the maintenance, docking, cleaning, maintenance on a boat, owning a boat, the true cost to own is going to take a lot of cash out of your hands on a yearly basis that could go into investments. That's just an example. Owning a very expensive car, multiple cars. Some cars, I would use an example as Mercedes-Benz. The car, you might find reasonable prices compared to the luxury lines, but there's a difference of how much an oil change cost. Maintenance on a Mercedes-Benz and repairs can be very expensive. Other vehicles too. It's not just the one. I'm using that as an example. BMWs could be another one, Jaguars. The point is that it's not just the price of the car, it's what we call the true cost to own. So on that line about sacrifice purchases, it's not just future purchases. It's assess what you have now and where your money is going, and can you reduce your cash outflows. Take advantage of employer-sponsored retirement programs. Yes, we call that free money. Most of those, while you do contributions, let's say a matching contribution, that's free money. That's 100% on your investment, or 100% return. Now, it is a retirement program, so the benefit is mainly building towards your retirement. But still, you should do it, because even if you have to pull money out early and take the tax penalty, it's still better than not doing it, because remember, a lot of that money was just put in by your employer for free. Participate in elective savings programs, automatic payroll deduction. Some people don't have the discipline to put the money aside themselves. So, but if you go ahead and fill out the form with your HR, your payroll, they can automatically deduct it and deposit it straight there. And even though it's still the same effect, it feels easier to do that way. Think of it as a subscription. We like, in the finance world, we like to say, pay yourself first. Instead of paying Netflix and the credit cards and all that, which you do no problem with automatic payments all the time, you should give yourself an automatic payment. You're paying yourself as well. Make extra effort to save 1 or 2 months each year. So by savings here, what they're saying, yes, that's the rule of thumb of maybe around 10%, because that amounts about 10% when you do an average of 1 to 2 months a year. But this doesn't necessarily mean just put in a savings account for your emergency fund. Savings here, the word is used in general. Yes, your first amounts of money should go into that emergency fund, which is just a savings account, even if it's not producing any cash. But saving in general is, once you have that 3 to 6 months, or how many months you find suitable for you, is to then save it in a brokerage account, CDs, bonds, stocks, whatever it is that you're investing in. So that's what that savings mean. It's not just necessarily a savings account. How the time value of money affects your investments. Many people never start an investment program because they have only small sums of money. This is a huge mistake, very common. People go like, right now, let's say you just graduated college, so you're making a decent paycheck, but you don't have a lot of disposable income at the beginning. That could be the case. I'm not saying that's going to happen, but it could be. They go like, I can only put aside while I, get my budget straight and my finances straight. I only can afford $20, $30 a month, right? Well, believe it or not, that is what you should do. Even if it's $5, even if it's $10, even if it's $20, start an investment plan and start putting money in. And it's because the biggest contributor to growing your money is time. Always keep that in mind. It's time. Even if it's a small amount, $20 now is going to be a lot better than $100 a few years from now. Just got to trust the time value of money. Factors affecting the choice of investments. Safety and risk. Generally speaking, in order to get higher returns, you just have to be able to take higher risks. Now, there is an optimal point. You should not take unlimited risk and assume it's unlimited return, because then you get into the side of investments where it's almost a sure loss. The classic example, extreme, but as an example, is playing the lottery. Yes, if you win the lottery, the return is insanely high. Out of $1, it's a $1 what you played, for example. However, the likelihood, because the risk is so much greater than the potential reward, the likelihood of you losing that dollars is just almost certain that you'll lose that money. So there is a point where you should not keep on increasing risk in order to try to get that increased return. Now, I'm not saying that you can't win the lottery. People win it all the time. We're just doing a comparison of risk and return where it has to be managed properly when it comes to these things, especially for retirement accounts. Now, notice here the bottom says speculative investment. We just call that speculation for short, in a high risk investment made in the hope of earning relatively large profits in a short time. Lottery falls in there. Right now, cryptocurrency is just speculation. It's too high, it's a very high risk. Some people are getting some nice amounts of returns, but most people are not. So you got to be careful with this. You want to stay in the investment side of the house. You don't want to cross over to speculative. That's gambling. Risk tolerance and calculating return on investment. Your risk tolerance. Earlier, I mentioned something about being able to wait a couple of years if the markets are down in order to enjoy the big upswings later. That takes patience. That translates to the term risk tolerance. You need to have certain amount of risk tolerance to be able to enjoy the returns that come with it. If you panic, you stress out, that means your risk tolerance is low, and you're bound to make mistakes at the wrong time. Calculating rate of return, pretty much it's just how much money you put in, how much money you got out, or how much have you gained, let's put it that way. And then you do your calculation, how much did it grow? That is your rate of return. I'll give you a rough example. Let's say that let's say you have a stock that you're invested in. Now you need to calculate everything that you got out of that stock. So let's say you put $100 in it, and let's just say a year goes by. And in that year, the stock is now worth $108, but also they paid you $2 in dividends throughout the year. It sounds kind of high, but let's just go with it. So let's say they had a good year. So your total return, you have to count the $8 that gained in value from 100 to 108, plus the $2 dividend you received. So your total money that you're receiving in value is $10. So when you take that $10 over the 100, you get the 10%, and that's your rate of return in an example like that. Investment income. Safest investments, predictable source of income, passbook savings accounts, certificate deposits, security issued by U.S. government. Yes, some of these are in the safest of side, in the safest side that there is. And when they say predictable source of income, let's first define what investment income is. There are some, let's say, bonds that pay a periodic interest, and it's fixed. You will get this dollar amount every so many months. That's it. So you get those interest payments when you buy a bond, for example, and it's predictable, it's fixed, and all that. Now, the point is that that's safe, right? So that's considered low risk. So you expect the return on your investment there to be a little lower, but it's there. Some securities that have a very fixed or very a good record of paying dividends may be considered investment income, but they're not as safe as the ones that are talking about here. So investment income doesn't have to be safe. There's just some types of investment income that are safe. So stocks that pay dividends regularly, and you can pretty much set a clock to it. Sure, they're investment income. They get dividends. Technically speaking, anybody that pays dividends is investment income. It's just not as safe as these examples. Higher potential income investments include municipal bonds, corporate bonds, preferred stocks. So here we go, municipal bonds and corporate bonds. That's what we're talking about. Those are fairly steady on investment. Now, preferred stock, which is not the same as the typical stock you will buy in the market. Preferred stock is a different class of stock. They typically have, let's say, a guarantee, not guaranteed, but they will have a fixed dividend payment. However, it's not guaranteed because if the company's low in cash, they can just skip it and not pay you the dividend that year, for example. And then select common stock. That's what I was talking about. Some companies are very good about their dividend payments, but nevertheless, notice here it says highest potential for income investment, but it doesn't have the word safest anymore. Mutual funds, real estate, rental property. And the reason is because you get that rental check. Mutual funds is pretty much another way to call common stocks within this definition, because what it means is that it has stocks in it that pay dividends. Investment growth and investment liquidity. Okay, let's talk about growth. So these are investments, growth, that you need to think long-term. This will be similar to the example I was given earlier, where you have to survive the downturns to enjoy the upswings, but that takes time. And the idea is that these are the ones that have a good opportunity of growth, but you have to be patient. You have to give it time for it to work out. And that's what they're talking about there. So growth means investments will increase in value. Common stock is your typical example. Not all common stock are considered growth stocks, but that's the point. Now here, growth companies pay little or no dividends. And the reason is because the less dividends they pay, then the value of the stock goes higher because the value of the company is going higher. Here's the logic. When a company pays dividends, value dollars are going out of the company. So the value of the company is not going down, but it doesn't go up as much as it would have kept the money. And we call that retained earnings. And at the end of the day, there's the return on your investment about the same, but there's a difference between collecting dividends versus just watching the stock grow faster. Select mutual funds and real estate offer growth potential. So, but I mean, select as some mutual funds are dividend heavy, some are not. So if they're not dividend heavy, those are the growth ones. Real estate has growth potential, but that one uses, in order to establish a piece of real estate to be in the growth side, in the high growth area, there's a lot of ifs that come with real estate. In general, when you put all together, real estate may have some good years, but it would be considered slower growth than common stock. But it's safer in a way. Investment liquidity, ability to buy or sell an investment quickly without substantially affecting the investment value. Okay, it says there real estate is not a very liquid investment. So there is some liquidity risk, which is a different type of risk. Let's start with the definition. Liquidity means that you can sell it for cash or exchange it for cash fast, but you have to add in the definition without losing value. And this is what I mean. Let's say I buy a house for $100,000, $200,000, $300,000, doesn't matter the number, $1 million. I can sell that house really, really fast if I sell it for $10. It would be sold really fast and for cash, but you lost a lot of value. So that's not considered liquidity. The idea is that something you can sell fast without losing value. Examples, gold is typically very good, but in high volatile times, it might be problematic. Bonds, unless there's a lot of volatility in interest rates, that's you find there. Some things, that's it. You can just sell them fast without losing value as long as they're stable. And of course, cash being the most liquid item is cash. Asset allocation, investment alternatives. So asset allocation and diversification. The process of spreading your assets among several different types of investment to lessen risk. Diversification is the key. And by asset classes, think bonds, stocks, CDs, money market, mutual fund, all kinds of different asset classes. Also, a variety of industries will help you here for diversification. You don't want all your investments in one industry, be it, let's say, tech. Sure, they may have a lot of good years, but then they can really have some drops sometimes, especially in the wrong companies. So you just want to have a variety of investments. The time factor, the longer that you're invested, the better your opportunity of increasing returns. We spoke about that earlier. Even if it's $20, the earlier you start, the more money you're going to make, no matter how little it is that you put it in. Your age, the type of your investment should change with your age. This is more talking towards retirement. And the idea is that if you're in your 20s, for example, you still got a good 40, 45 years before you even start thinking about, before you actually start getting into retirement age. So the idea is that since you have all that time and you shouldn't be using that money, then you do not need heavy liquidity, you need growth. So you want to be in your investments that are pursuing growth and grow as fast as it can. But as you get older, you need to shift away from those high risk, high return growth investments and put them and start shifting them little by little to safer investments. So once you reach retirement, you have liquidity. At that point, you want to be able to use that money without losing value. Here, notice at the top, speculation again, stay away from there. Stay away from speculation. You should never be there unless you just have a little side fund, a budget for gambling. Now, besides that, stay away from there. So typically when you're young, you start at level 3 growth. There's an oversimplification, but it gives you the message. When you're young, you're looking into this growth. Now, to be honest, they say rental property there. That's it could be debated. It can be debated because rental property is more of an income thing and they grow slower. Now, because it's real estate, it could be classified as growth. It just depends. So not all rental property, let's put it that way. Not all rental property automatically means growth. Safety and income, as you get older, you start shifting level 2 where you put things into capital preservation. You don't want the value of your investments to start have too many swings. And some of it starts extracting some cash to put into safety. And then at the end, it's just financial security, where you just need a lot of liquidity so you can then enjoy your money. Now, what happens as you get older, you're just shifting in levels, but it doesn't mean that you completely step out of level 3. Because let's say you retire at 65 and your life expectancy is 95, that's still 30 years. So a piece of your investment can still stay in growth, just a lot smaller piece. Your financial advisor will be able to explain this to you better once you're in that situation. Stock and equity financing, equity capital. Okay, so we're going to pretty much explain what stocks are here. Just a quick overview. Equity capital is money that a business obtains from its owners. Stockholders buy shares of a company's stock. Stockholders buy shares of a company's stock. This is just, have you seen in the TV shows and the movies? Investors put money in a company and the company uses that money to grow. And when that grows, then the value for investors goes up. So there's many ways to do that. But when it's a corporation with shares, you buy shares. And that's what you do. And that's how you invest in the company. Stockholders are owners and share the success of the company. So you are ownership. And it says that they share the success of the company, but you also share the risk and the losses. Understand that. The corporation is not required to repay the money obtained from the sale of the stock. That's where it comes in. They say, like, look, if the company does well, your stock price goes up and you make your money. But we're not obligated to return your money. Once you put it in there, you are taking the risk of that you may lose it. The corporation is under no legal obligation to pay dividends to stockholders. It's a choice. Dividends are a choice, and they may start paying them and then stop them whenever they want. It's not a good thing for them to do that, but it is possible. They may instead retain all the part of the earnings. I mentioned that word earlier, retained earnings. 2 basic types of stock, common stock and preferred stock. Common stock is what you typically hear out there. Preferred stock, it's typically currently offered, and the company picks who gets to buy from it, typically. There are other things out there like corporate and government bonds. A bond is pretty much a loan. It just has a different structure. It has different definitions and some legal requirements. But when you buy a bond, you're making a loan to the company or the government. And that's what it is. A corporate bond is a loan to a corporation, the government, or municipality. Bondholders receive periodic interest payments, and the principal is repaid at maturity. That second bullet is describing an interest-only loan, but not all bonds are like that. It's some bonds don't pay you anything into the end, and they just give you a lump sum at the end, which is higher than what you paid for it. Bondholders can keep the bond into maturity or sell it to another investor before maturity. Bonds do change in value as time goes by for different reasons. And then just like stocks, you can trade them. Go ahead and sell them. So they went up in value. You can sell it and get your gains. Or you just continue holding to the bond to continue collecting the interest payments. Mutual funds. The investor's money is pooled and invested by a professional fund manager. So mutual fund, just kind of like what it sounds like. People come together, and this fund manager is just collecting money from people, and they all invest in this portfolio of stocks. So everybody will be invested in the same portfolio if it's a mutual fund. And what you're doing is you're buying shares of the fund, which in turn gives you percentages of every of the stocks that are in there. So mutual fund is a portfolio of stocks, but you're not buying those stocks specifically. You're buying pieces of that combined portfolio. Real estate increases in value and eventually sells at a profit, but there are no guarantees. In the United States, the real estate has always been able to grow. You have good years and bad years, but it grows fairly steady. But that's not the case for every country. Something to be aware of. There's no guarantee that real estate will go up in value. Now, what you may have also, when I say the United States, I was on average. Sometimes some towns and cities have a really bad downturn, and they never recover the real estate assets until like decades later. It's just the way it is. Other investment alternatives that are out there. These are more speculative stuff. So you always want to first take care of your emergency fund, your standard investment practices and portfolios, and all those other things we spoke about, liquidity and growth and all that. Now, you still got money that you think you don't need to continue growing your brokerage accounts and your standard investments. Then there's these other speculative items. You heard about them: options, commodities, derivatives, precious metals. That's where gold is in there. Coins and stamps, antiques and collectibles. But that's like I said, we use the word speculation, and just think of it as gambling. A personal plan for investing. So let's go over it. The steps. Establish your investment goals. That's how we started this lecture. Determine the amount of money you need to obtain your goals. So on both ends, if you're going to retire, how much money you need saved up in your investments to be able to retire comfortably or at the level that you would like to, and how much money you need now and throughout time to get there. Specify the amount of money you currently have available to fund your investments. Just look at what you have, see what adjustments you can make. And it's not just how much money you have now, but also how much can you continue depositing periodically. And that goes back to those sacrifices you have to make, not eating out as often. List different investments you want to evaluate. At that point, you're starting to choose which portfolios, investment bonds, etc. you would like to be in. Evaluate risk and potential return for each. This goes back to risk versus return. As we said, higher risk means higher return, but there is an optimal point, because after that, you run into speculation, and then the risk is too much considering the potential return. Reduce possible investments to a reasonable number. And that just means that as you're picking and choosing your investments, you want to start narrowing it down. These are the ones I'm comfortable with. Reasonable numbers, you don't want to all of a sudden find yourself trying to choose between 75 different portfolios. Choose at least 2 different investments. Yes, that's all I'm going to say on that. You do want to, if you want to do a few more, that's recommended. So what we're saying is you don't want to have a large variety unless you have a very complex portfolio situation or a lot of money. Yeah, you should have at least 2 different investments. Continue to evaluate your investment program. Just start the cycle over. Just measure, look, adjust as necessary. That will be it for this video. See you on the next one.